Hello all, you're very welcome to the BVP Investor webinar, and thank you for joining. I'm today's presenter. My name is Connor Duggan and I'm the Investment Director here at BVP. My contact details are below, so if you have any questions about the webinar or about anything else, please feel free to contact me. My email address is connor, C-O-N-O-R, @bvp.ie. My phone number is 016572900. So in terms of today's agenda, I'm going to start by giving an intro and background to BVP. I'm then going to spend some time talking about the EII scheme, and I'm going to walk through an example of how it works in practice. I'm then going to talk about some of the changes to the legislation that have happened in recent years and the impact that those changes have had on investments. I'm then going to look at two investment case studies from two companies that we've previously invested in. I'm then going to spend some time looking at key sectors that have been a key area of focus for us, both in terms of past investments and for future investments to come. And then I'm going to conclude by talking about key takeaways and the conclusion. So in terms of BVP, we're an investment manager that's regulated by the Central Bank of Ireland. And we manage EII funds, which the revenue call designated funds. But essentially, we take money from investors and we pool that money together, and then we make a number of investments with that pool of money, as I'll explain later in the presentation. So we're based in Dublin, in Sandyford, and the company was founded in 2004 by Elliot Griffin, who is the managing director. And the areas of focus of investment for us historically and I suppose into the future are in the areas of renewable energy, energy efficiency, mobility and transport, health and well-being, and information communication technology, or ICT. So here at BVP, we've been managing EII funds for 12 years, and the fund that we're actually currently in the process of raising is our 13th fund, or what we now call our 2019 fund. We currently have 38 million euro under management, and we have over 500 individual EII investors, many of whom have invested in multiple funds, so they kind of come in every year. Our funds have invested in over 30 Irish companies, and we've also been quite close and quite involved with the revenue in terms of kind of encouraging changes to the legislation and working with them to try and get a better outcome for everyone. In terms of the team, we have a mix of finance and industry experience. The team is, there were 7 members at the moment, and we kind of come from a mix of backgrounds. Some of us are chartered accountants, some of us come from an engineering background, some of us come from kind of a environmental or sustainability background. And most, if not all of us, have worked in operating companies as well as for investment managers. So we kind of, we go across, both sides of the fence, if you like. So we've worked in real business, if you like, and we've also worked in the management, the asset management business. And just to point out then, we've done a couple of private placements for wind projects and for individual portfolio companies. So about the scheme itself, EIIS, it stands for Employment and Investment Incentive Scheme, which used to be called the Business Expansion Scheme. And the idea is that it's a source of equity funding for Irish small and medium-sized enterprises. So this is not a debt product. This is equity that goes into these businesses. And it's a revenue scheme that's designed to attract investment from individuals into Irish businesses. And what the individuals get in return is they get tax relief of up to 40% on the amount that they invest. And they still have the opportunity to benefit from capital appreciation of the amount they put in. So I'll walk through an example in a couple of slides, and that hopefully will come a bit clearer. So it essentially allows investors to deduct the amount of the investments they make against their total income for either the year that they make the investment. So the year, say 2019, if you were to invest in this fund, you can write off your investment against your 2019 taxable income, or you can write it off against your 2020 taxable income. Because you invest in the fund in 2019, but the fund itself doesn't invest the money until 2020. So you essentially have the choice of either or. And that's different to a direct raise. So some of you might be familiar with investing directly into companies. In that case, you can only apply your tax relief against the year that you made the investment. So it's slightly different to investing in a fund. And then just to point out that part of the EIIS legislation is that there's a minimum holding period of 4 years. So essentially, you invest the money gets invested in these companies, and the plan is that the money is held there in those companies for at least 4 years. So who is it suitable for? It's suitable for anyone who has a taxable income liability, in either, say, for this example, in either 2019 or 2020. And your taxable income can include multiple sources, including PAYE, rental income from properties, other investment and income like dividends, and pension income. So here's a practical example. I'll just give you a minute just to look through it. But essentially what it shows is two examples. So if you look at the top column, it's gross pay. So in the column to the left, the person has gross pay of 78K, and equally on the right, same thing. So in the example on the left, the investor has invested 40,000 into an EII investment, and therefore his or her taxable income is now reduced to 38K, as opposed to 78K on the column to the right. So the net effect of this is that the investor on the left has saved 16,000 euro through investing in the EII. And the 16,000 euro, it's 40% of the 40,000 that was invested. So that investor has essentially got 40% tax relief up front, or in other words, has got a return of 40% in the first year. And it's worth keeping in mind that the 40,000 that was invested, that money is still subject to capital appreciation. So if that gets invested into the fund on day one, say by after 4 years, we would hope that amount has appreciated by 20-30%, and that's on top of the tax relief that you've received. So I'm just going to talk briefly now about some of the changes that have occurred to the legislation, and some of this is quite important. So if we start with the first point there, this EII company self-certification. So this is a huge change that happened last year with the Finance Act. So it now means that the onus for approval has changed. So historically, companies would have to apply for tax relief to revenue, and that could take a long time because they have a big backlog, and it took a lot of kind of interaction between revenue and the company to get approval. And that's totally changed now. So now companies self-certify. So they issue a statement once we've made an investment, and once they've spent 30% of the money, they then issue a statement to revenue saying that they are EII compliant. And that then triggers the investor to be able to claim his relief straight away. So essentially you're cutting the turnaround time into a fraction of what it used to be. And some of you who may have invested in previous funds, be it in BVP or other funds, you're probably familiar with this, the headache of the hassle waiting for it, which now has essentially gone away because of the self-certification thing. The reduction of risk is another thing I wanted to talk about. So EII shares historically, up until this year, had to be into ordinary shares. So the money was invested by the fund into an underlying company, but we could only invest in ordinary shares. And what that meant was that we were essentially on a equal footing with the founders. So if another institutional investor came along who wasn't investing under EII, they could get preferential shares. So they could get better terms than we got. And one of the big issues that it created was that institutional investors could get what's called a liquidation preference. And what a liquidation preference means is that you get preferential treatment in the event of a sale of the company, or in the event of the liquidation of the company. So say, for example, an institutional investor was to invest $1 million, and the old EII scheme was to invest $1 million as well. If that investor had a liquidation preference, they would then get that $1 million back before any of the EII or the founders were paid back. And so we can now invest in these shares. So that was another change that came out of the 2018 Finance Act. And that now allows us to benefit from the protection that a liquidation preference gives. And we see that as a key change because it gives downside protection. So, you know, all being well, you know, you never have to be you never wish that you'd be in a situation where this becomes a matter. But if and when it does, it gives significant downside protection. The other thing that's worth pointing out in terms of risk is that the company now has a responsibility that when they claim tax relief, so when they issue a statement to say that they're a qualifying company and therefore they qualify for relief, the liability is now between the revenue and the company. So the underlying investor doesn't get impacted at all. So say, for example, if you were to make a claim for tax relief and it then became subsequently clear that the company that had issued the statement issued an incorrect statement, you wouldn't be impacted. So there's no clawback on relief. The clawback will be between the company and the revenue, which is a key change. Another positive change is the tax relief. So some of you may remember that historically it was broken into two tranches where you had 30% relief up front and then 10% in year 4. And the 2019 finance bill has changed that. So now it's 40% tax relief up front, which is a huge benefit to investors. And likewise, investors can now claim relief on up to 250,000 in any one given year. And it used to be 150K. So that's definitely a welcome change as well. So this is just an illustrative process of the tax relief timeline. So I think this is just worth pointing out just so that you get a very good understanding of exactly how the timeline works. So this is an illustrative example of fund whereby we will make 3 investments. So you'll see starting on the left and kind of working down, you'll see company A, company B, and company C. So company A is the first investment that the fund makes, and that investment closes on the 31st of January. And then the company itself has, it can issue a statement of qualification once it's spent 30% of the EII money. So in this case, that's been done by the 30th of April. And then the company issues a statement to both BVP and to revenue that it qualifies under EII. In the second example, company B, the investment is closed by the end of March. And by the end of June, the company has spent 30% of the money it's raised on qualifying purposes. And then by the 15th of July, it's issued a statement to both BVP and to revenue. In the third example, company C, the investment has been closed by the 30th of June. And by the 31st of October, the company has sent out, it spent the 30% of the money. And then by the 30th of November, it sent out a form to BVP and to revenue. And so in the kind of pink box down at the bottom right, you'll see that either by December 2020 or January 21, BVP are now in a position to issue consolidated statements to investors that they can then claim relief on. So essentially, we collect all of these certificates from each of the underlying companies. And then once we have the individual certificates, we then issue a consolidated statement, and that's what you can use to claim tax relief. So just to cover off on some frequently asked questions, the first question there about the exit during the 4-year minimum holding period. And just to let you know that an early exit will result in a clawback of any tax relief obtained. So the 40% that you receive in the year 1, that's contingent on the investment period being at least 4 years. So there's a minimum holding period of 4 years. So if there's an early exit, you actually lose that tax relief. So in terms of the second one, the investor owning the shares in the company, for designated funds like BVP, the shares are actually held by a trustee, an independent trustee on the investor's behalf. And actually the cash that you invest, that's actually held by an independent trustee as well. And us as the fund manager just instruct the trustee to move money into these companies and then to distribute money once we make exits. So the third point, just around when you can claim relief. So you can claim in 2019 or 2020. And that's a key difference between investing into a designated fund like BVP versus investing in directly into a company. And then finally, in terms of the minimum and maximum investments, there's a €10,000 minimum and a maximum of 250,000 per person, so double for couple. And so it's actually quite important to point out as well that in the event that you invest a significant amount and you don't have enough taxable income to write it off, you can roll it forward. So there's no use it or lose it. You don't lose it. You can just roll it forward into future years. So I'm now going to look at 2 case studies, which are previous investments we've made, which I hope you'll find somewhat interesting. So the first company is a company called EFT, and it's a company that offers energy management software. We invested in that company in 2008 when the company was only a 5-man operation in Wicklow. And at the time that we invested, the company had modest profits and a really ambitious founder, and he wanted to expand to the UK and to the US as well. Our investment allowed additional managerial hires. So essentially the management team was expanded through the use of our capital. And it allowed the managing director to look more strategically at the business. And at the time that we invested, their sales function was dependent on one channel partner, which was the ESB. So he kind of wanted to be focused on expanding that into more sales channels. And some of the investment was also used to improve the functionality of the software. And over time, the MD actually ended up relocating to the US, where he found other funding partners and other sales channels. And one of the key customers that he had at the time was a large industrial conglomerate called Koch Industries. And they ended up actually acquiring the business, which generated a very attractive return for our investors. So Crowley Carbon is the next company we'll look at. And as you see in the picture, the guy on the left you may know is Richard Branson, and the guy on the right is Norman Crowley, who's the founder. They're an energy efficiency company that works with large corporates to reduce costs by managing energy usage more effectively and more efficiently. The company was founded by Norman, as I said, and he's built a really strong executive team around him. So when we invested in them, they were only actually operating in Ireland and the UK, and they've now grown to be operating in 9 countries worldwide. But I actually think that it could be even higher than that. They seem to be expanding into new countries every month at this stage. They only had 10 employees when we invested, and they've since grown that workforce to over 200 people. We invested with our 6th EII Fund and generated a very satisfactory return for our investors. So in this next section, I'm going to talk about some areas that have traditionally been areas of focus for us over the last number of years, and they'll continue to be areas of focus in the coming years. So the first 2 areas are medical technology and mobility. And we're focused on these areas largely because of the demographic and social changes that we see occurring. So as the population ages and life expectancy increases, we're seeing medical technology being an area of increased importance. And one of the biggest changes we're seeing in this area is in the area of patient care, as it moves from practitioner-based intermittent care to a more patient-based continuous care system. So essentially, what I'm trying to get at there is that, you know, the traditional kind of doctor-patient relationship was whereby you went to your doctor, you saw him, he then gave you, you know, he said, take this medication, do these exercises, and then you came back in 3 weeks or 3 months. And basically, in the meantime, there was no way of communicating with each other. Whereas that's changed now. So there's a big focus on kind of continuous care where you're always in contact essentially, and you're always feeding results back, which means that drugs are more effective and treatment can be changed quicker. And essentially, you know, the overall treatment, the overall experience of the patient is much better. So with our 11th fund, we invested in a company called Health Beacon, who are in this sweet spot, and they develop and sell digital tools that patients use to record and track their medical usage on a daily basis. And this data is then relayed to the doctor and actually can be relayed to family members if you'd like. And so it allows almost real-time monitoring of drug adherence is what the area they're focused on. And medical technology is going to be an area that we're going to focus on for our 2019 fund. And we've already identified 2 potential investee companies in this area, and they'll be along those kind of lines of that kind of continuous care theme. Mobility is another area that we're focused on, and we see it rapidly changing at the moment. There's been an increased focus, as I'm sure you're all aware, over the recent years on energy efficient modes of transport, including electric vehicles. So these are some of the companies here. That's Health Beacon there on the right that I spoke about. But with our 12th one, we made an investment into a company called UFO Drive. So you'll see it there in the middle. It's not UFO Drive, it's actually pronounced UFO Drive. And they offer rentals of electric-only vehicles. And the key thing is that all of the experience is done through the app. So the days of standing in line at an airport and waiting to get to the sales desk and then feel like you're getting kind of, upsold at the sales desk, those days are over. And Aidan McLean is the founder of the company. This actually came out of his frustration. So he was traveling from a business trip in Europe, and he had a bad experience. And on his flight home, he began thinking about how he'd like to design an ideal car rental company if he could. And so he decided that he only wanted to operate, or he'd only like to rent electric vehicles. But more importantly, he wanted to do it so that he didn't have to deal with anyone. He could do it all through his app. And that's exactly how this works. So everything's done through the app. You make the reservation through the app. You know exactly where your car is. So when you land in the airport, you go straight to the car park, and it tells you on the app where the car is. You open the car with the app, then you drive away. And then the other frustration that it takes out of car rental is that you don't have to refuel. So traditionally, you have to refuel before dropping it back, and you're probably in a rush for your flight, and it can be quite a pain. Whereas now, he's taken that out of it, and all you have to do to end the ride is just plug the charger into the wall, and off you go. Finally, another investment we made in the mobility space is a company called Bleeper Bike. It's Ireland's first stationless bike sharing company. They currently operate a fleet of 500 bikes, and they're soon going to have an additional 750 bikes. And then in 2020, they're going to be the first Irish bike company to roll out a fleet of e-bikes. Resource management is another area that we're focused on. And we're constantly looking for businesses that can increase the effectiveness of resources, be it either natural resources or human resources. We've done multiple investments in renewable energy projects in the past, which include wind farms and anaerobic digestion plants. And we plan to make more renewable energy projects or investments into renewable energy projects with our upcoming fund. Another investment we made was in the 12th fund with a company called Tandem HR. And they've developed software for large enterprises that allow performance management to be done on a continuous basis as opposed to once a year, which is probably still very common with a lot of organizations. This focus on continuous performance management leads to higher employee retention and also makes it easier for large corporates to facilitate global mobility of its workforce. So they're kind of they're focused on 2 common issues that large corporates are facing, that being employee retention and global mobility, and how easy you can make it for people to move around. So in terms of key takeaways, just to remind you that BVP are a designated fund. We're regulated by the Central Bank of Ireland. That EII is suitable for anyone with an income tax liability in either the year investment in the fund or the year that we make the investment, in this case 2020. Investors can earn up to 40% tax relief. The product is for equity investments, so it's not a debt product. Companies are now responsible for self-certification, which is going to give much quicker turnaround and also puts the risk on the company as opposed to the investor. We can now benefit from investing in preference shares, which substantially reduce the risk to investors. And the minimum holding period is for 4 years. So just to talk a little bit about the 2019 EII Fund. So you'll see here that we've launched, first of all, and we are targeting to invest in 4 or 5 high growth companies in the sectors that we've outlined below. And the closing date is the 31st of December, and the minimum investment amount is 10,000. And then the proposed exit date is after the 4-year minimum holding period is the 31st of December 2024. So if you're interested in making an investment in the 2019 EII Fund, you can go on our website. We have a tax calculator that you can use to see how much tax you can save. You can contact us to receive an investment pack, which will give much more information about both EII and the fund. The email address is hello@bvp.ie, and the number again is 016572900. We'll also issue you an application form, which you can fill out physically and send to us, or you can fill it out digitally and send it through software called DocuSign. And then we accept checks, bank drafts, or EFTs. And then we'll ask for, as part of our AML, we'll ask for identification and proofs of address, which can be done through IDPal. So that's the conclusion of the presentation. I hope you enjoyed it. And if you have any questions about either the EII scheme or the 2019 BVP Fund, please don't hesitate to contact me. Again, my number is 016572900. My email is connor@bvp.ie, or you can check out our website at bvp.ie. Thanks again.